Basically, if you have any questions, just put it into the chat box, and we'll make sure we get those questions over to Jeff or myself during the presentation. If there are questions that need more detail, more information, we'll wait to the end, and we'll answer it at that time. We've allotted some time for Q&A at that point. We want your feedback as much as possible. So once we get done this presentation, I'll be sending you out an email. Any feedback that you can present to us would be much appreciated. About 15, 20 minutes ago, I emailed everybody a PDF document of Jeff's pre-market routine. That's yours to keep, and Jeff will be making reference to that when he gets to that point of his presentation. There's a lot of really good information in there, so make sure that you refer to it not only during the presentation, also but during your trading day. So this is going to be our agenda for tonight. We're going to kind of give you a very brief background on who Majestic Trader is. Going to introduce Jeff. Jeff's going to go through his pre-market routine referring to that document we sent over to you. He's going to go through a trading lesson and then also give you some trading ideas. And then we'll open it up for Q&A, so don't be shy. So to give you a very brief background, MajesticTrader.com has a weekly newsletter publication that we post on Sunday nights. This is our copy of our website in front of you. Essentially what we do is we are stock pickers. So we present trading ideas every single week, and during the week we run scans, and if specific trading ideas come up on our radar, we will make sure that we get out these trading ideas to our membership during the week. Because obviously we're going to put them into our newsletter publication on Sunday. We want to make sure you have full advantage to take advantage of those trades during the week. So you can go to our website, get more information. Just to give you an idea, our newsletter contains market commentary. We give you basically all the open positions and a list of all the trading ideas that also includes the entry, the targets, also recommended stop losses, and the notes on the best way to manage those trades. We also give you our results, and in our membership section, we give you complete trade performance. So since the beginning of the year, and we update this monthly, we give you a list of all the trades, entry, exits, winners, losers, so on and so forth. So we give you a list of those, and then we give you a market forecast where we see the market going, what are the levels that you should be aware of, and we've been pretty accurate this year calling the turns in the market. I'm sure that Jeff will touch upon that in a little bit. So that's a brief background on who MajesticTrader.com is. I want to introduce Jeff Manson. I've known Jeff probably for maybe a little less than a year at this point. Jeff has a very unique trading method that he's going to go through, and it doesn't matter whether you're trading the equities or the futures. His methodology is based upon ABC pattern and Fibonacci, and he's going to go through a lesson on that for you. I would also pay very close attention to any trading ideas that he gives to you during this presentation, and strongly consider those as part of your trading queue. We'll talk about risk management at the end of the presentation. So without further ado, I'm going to turn this now over to Jeff. Jeff, you should be able to take hold of it, and everybody should be able to hear you now too.
Okay, good afternoon, everybody. Happy to be here. How's that for sound?
I can hear you fine.
Okay. My screen, everybody see the screen too?
Yep, everything looks good.
Okay, everything looks good. All right, let's go ahead and get started. Well, some of you know me, some of you don't. I really don't spend a lot of time talking about me because you're here to learn about what we do and how we do it, and get some trading ideas. Now, I do like using Fibonacci measuring tools, and I make reference to Fibonacci being more of a measuring tape than anything else. There's many different ways to look at the market, but if I can measure it, it gives myself or gives me an added level of confidence in that particular trade. Let's see, I'm just kind of looking at Morgan Stanley here. I just kind of threw it up here. I have this nice little swing and coming down and another swing going up, and you'll notice that I have a unique style where I use the 50 simple moving average as a mean for my measurement. Okay, anybody using Fibonacci, studying Elliott wave and all those forward-looking type techniques, even if you're using Gann or Jim Wyckoff as far as using price and volume, everything that we do in the market needs to have a mean for our measurement. This allows us to trade the right time frame as well. And since I mentioned trading the right time frame, I'll cover just a piece of that, and maybe I can do more on that a little bit later. But I want to show you how to kind of scope into your trade. We have 2 points up here, as you can see outlined in with the black line, and I'll grab my Fibonacci measuring tape of sorts, and I'll pull from high to low, because what I'm looking for is if there is a measured swing up into this level here. So if I have an extension, and you can see all the Fibonacci levels that I use here, for the most part I have extensions that exceed 100, so 113, 127, 1618, 224, 2618, and 314. Of course, there's a lot of other ones you can use, a lot of square roots that we can use that are not posted on here. Okay, my retracement levels: 38, 50, 618, 78.6, and the 88.6. Okay, now these levels here, that's what makes sure. These levels here are ones that I use for specific chart patterns. Okay, now I like to use these patterns because they lead me into the next one that I'm looking for. So I'm going to put some labels on here just to show you a little bit about what I'm looking for. I have an X point, a Y point, and in this case this is A, and A equals 113 extension of the prior swing, which is X and Y. Now for what I'm doing here, if A equals 113 extension of XY, I make plans for my point B to equal a 127 or 161.8 extension of the prior swing, which is now Y and A. Okay, so as I'm looking for my exit point, I'll pull from low to high to measure that, and then I'll look. Okay, we came right down and hit the 127 level. Okay, and that would have been my first objective, to take a profit. Okay, so if A equals a 113, B equals 127 or 1618, I like to look for C on this structure. C will generally equal a 0.236 retracement or 0.382, again retracement, of prior swing, which is A and B. Okay, so as I move and identify my swing down to find point B, I want to look for that shallow retracement back up and see if it helps qualify. Now it must be a shallow retracement in order for things to play out. Okay. Okay, we went right up to the 23.6. All right. Now to complete this price pattern or price structure, what I look for is the end of the cycle move that's a D point, to equal a 161.8 or 224 extension of how this move already started, or how it began, okay? And that'll be pulled from Y to X, okay? Every story that starts, you know, the reversal pattern started here, the trending pattern started here, and now the end of this full reversal should be located right around the 1618 or 224 extension when I plot from Y to X. Now, this is a unique way of measuring price behavior. And here we have the 1618 right here, which would have played out nicely. Great exit. And then we have kind of the end of the move down here at the 224 extension. Okay. Now, not everybody thinks in this way. Not everybody likes these price structures, and that's okay. I know that not every trading style is for every person, or we'd all be trading the same thing. Many of us have some skills, and when we've been working in past jobs, it requires us to have absolutes in order to manufacture a product, in order to create an end result on a job or anything like that. When we come to the stock market, we kind of throw all of our learning, all of our education out of the market, and we don't, or all of our skills that we have at work, we kind of throw them out, okay? And they're very useful. They help us make decisions in life. They help us understand really where things are going if we know where we are in the process, okay? So I like to have things measured out in order to help me find my way. Now, I also have a plan to enter a trade using an 8 simple moving average. So as price closes below an 8 moving average, and you'll see that I use a 50 moving average, a 200, and an 8, okay? So the moving averages that I use are 50, 200, and an 8. Let me explain the moving average. The 200 moving average helps me identify my trends. 200 helps me identify trends. Swings above and below the 50 moving average help me identify my trades within the trend. Using an 8 moving average helps me identify my entries. All right? So I have an entry here as price closed below the 8 moving average, and the reason I'm taking that is because I have already verified the level that I was looking for. That prior level will then become my stop loss level. If A equals 113, then I look for 127 or 1618 as my potential exit point. Okay? Again, on this whole price structure, if the trend continues, using a 23.6% retracement, this is where I take a little breakout trade, because the 23.6 tends to be more momentum. Now, price retraced to the 38, I would use my tool up here, which is what I deem as my ABC tool, which is called a Fibonacci price extension, where I would have the deeper retracements, where I'd have point A, point B, point C. Now, the settings that I have on this, you'd find this one at 0. This one's about 14%, 50%, and 100 if you're putting in and setting this tool up yourself. Now, I highlight the line and make it more thick as well so you can see these different levels. The top level represents my stop loss level. This level, it represents my target entry level. This is my first exit point and my second exit point. Now, the first exit point has a 85% probability that it works out. The second exit has about a 40% probability. So what I ask my students to do is be assertive here and take the first exit. Okay? In the beginning, people are learning how to trade, not learning how to gamble and play the hope and dope game. Okay? If you're waiting and holding out for the 40% return and you have no, or 40% probability, that second exit, you really have no reason why you're waiting for it because you don't know when to wait for it yet. Okay? So if you're using an ABC setup, always look to take that trade off at the first exit. Now I am giving you kind of just an overview of things, but I need to get into that pre-market routine here. But I wanted to show you that the patterns and the shapes exist. Now many of these patterns exist, but it's when we put price on the chart, everything starts getting really noisy. Okay? And if we throw some other indicators on here, even if it's just moving averages, we have to learn how to cipher through all the noise on our chart. Okay. Now I have ISRG. I had as a potential candidate for a trade setup. Now this is one of my other chart patterns that I like to find. It's usually at the end of an uptrend. This is ISRG on a 30-minute chart. I locate the swing from high above the 50 moving average to the low below, and then I look for a swing back up through the 50 and a 50 moving average. Okay. As we identify our swings above and below that 50 simple moving average, I'm going to walk you through this setup, and then I'll get into the pre-market routine, and I have a few more candidates for us to look at. So right-click, format symbol, and I'm going to do this without using the right side of the chart. We're just going to use our stick drawing here. So as we do build that right side of the chart, most of the time we have to build it without seeing it there, right? Okay. So I want to ask the question: why did price stop here relative to the prior swing? Why did price stop at this level relative to the prior completed swing? So I grab my measuring tape out. I pull from high to low. I discovered that I've hit a 78% retracement. All right. If I have a 78 or an 88.6% retracement, okay, or any of my extension levels, I will label the prior swing X and Y, and this will be labeled as point A. A will equal, in this case, 0.786 retrace of the prior swing, which we have labeled X and Y. Okay? My entry on this will be as price moves lower. I have a point B in mind, okay? But as price moves lower, I will look to enter the trade as price closes below that 8 moving average. The prior swing high will act as my stop loss. Okay, so let's just go ahead and label this. Stop loss. Then I have my target entry, which is price closing below the 8 simple moving average, somewhere in here. Okay. Okay, so if A equals a 78.6 retracement of the prior swing, I will look for B to equal, looking for B in this level down here, B equals a 113 or 127 extension of the prior swing. Now the prior swing is labeled Y and A at this point. Okay. Now, as I'm looking for price to retrace down into this range, it doesn't always go in a straight line, okay? But we can hope that someday I'll get close enough for where it follows my lines. As price bounces up where I'm looking for point C, I'll use the AB leg, and I'm looking for a retracement back up. So what you're starting to notice is that the ABC leg, or ABC setup, is part of the trend, and we're not getting the high points or the low points, okay? C equals 0.382, 0.50, or 0.618 retracement of prior swing, which is labeled A and B, okay? So as we're looking at this structure, we have a retracement back up point C. The ABC leg is after we have put in a reversal pattern, and now we're going into more of the trending pattern. Now, point D is an extension of Y to X, okay? D equals a 1618 or 224 extension. So let's just label this. D equals 161.8 or 224 extension of the prior swing, or actually of how all this started, excuse me, of Y and X, okay? So let me tighten this up. Move this over a little bit so I can get another line. Right click, do parallel. And what we're looking for now is price to move down into this range here and maybe even go a little bit lower, okay? Now, we've identified a stop loss. We have a specific entry. We have a planned target entry. And we have some objectives along the way, okay? We'll come back on here and we'll format the symbol and we'll turn the lights back on our price. We'll kind of look where things are at, okay? Put my moving averages back on there. We'll notice that yesterday price closed below that 8 simple moving average, okay? So we could have taken this trade today at any time and gone short on this particular product, okay? With a stop loss right at the prior high. We still have little opportunity to get into this. Now, ISRZ on a 30-minute chart, just starting a potential move to the downside. A very similar pattern here, what was it, EXPD, and let's go to a daily chart on this one. Actually, one a little bit better, ESRX. Okay. ESRX had a nice little potential trade coming back here. This is one that's been playing out for a while. And we can see that this prior high was the highest point. Now I used the previous swing to anticipate where that high point would end up. And in this case, hit a 127. Okay, now I don't have time to go into all of the setups here, but you can see that these little reversal patterns are quite common and they're easy to spot once you see them. Now, all of them must qualify by price crossing a 50 simple moving average, but you can see the shapes of them pretty clearly, okay, just by going back and looking at the beginning of trends. When you have one at the beginning of a trend, it's usually a very good indication of a potential trade setup, a reversal play, in fact, okay? And here's one that extends down a little bit further. Let's see how it measures out. Right down to the 127, okay? Anyways, we'll come back and look at a couple more charts. I have a few for you to watch over the next few days, next few weeks, until I come back on and we do some follow-up. Yeah. But what I was asked to do was point out the pre-market routine. Okay. Now the pre-market routine I'll put up here, and I'm just going to maximize my window because I want to spend a few minutes on this. Okay. I want you to understand that the pre-market routine is an information gathering process. It's a process where we gather information about the markets in order to participate in those markets and participate in a trade. Okay? It is designed to understand the trading environment. Do not create a bias, make any decisions based on a single data point. The pre-market information gathering does not negate our technical analysis, our trade plans, our pattern recognition, or setups and entries. Okay? What I've discovered is that when we are, as instructors, training students to do what we do, they don't have a lot of the intuitive knowledge that we have gathered and collected and over time, and we can look and assess the market in about 30 seconds flat and decide if we're going to be long or short for the day. Well, a Newton has no idea what you're talking about and tries to make up a lot of things when they are trying to assess the market because they're trying to basically do what the instructor did, okay? But they really have no bearings or grounds for why price moved the way it did or why price went that way. In order to accelerate your learning curve as a novice trader or a beginning trader, however you class, or even an advanced trader, however you classify yourself, you need to start off with some measurements. Learning the different measurements, the different swings, and above and below a 50 moving average, measuring gaps, measuring volume, just measuring reaction to different news events. Okay? Documentation of these events will enhance and accelerate your learning curve extremely fast. Doing it the way I did will take you about 15 years. Okay? Your choice. The pre-market analysis is analogous to what you would instinctively do when you're planning to cross the street. Okay? Everybody picture themselves standing at the street corner. To safely cross the street, you would consider the width of the highway, traffic volume, traffic signals, marked pedestrian crosswalk signs, time of day, weather conditions, the girl across the street, the guy behind you that should have a shower, all those things. Everything is a piece of information at this point, okay? You take all these factors in consideration and look both ways before proceeding. If you determine it was unsafe, you would continue to monitor this information until you determine it was safe to cross. We all know that being oblivious to crossing a multi-lane highway at peak traffic without paying attention to traffic pedestrian signals is a deadly exercise. Okay? Being oblivious to the trading environment can also have a negative effect on your trading account, even with very, very favorable fundamental and technical analysis. Okay? So remember, always look both ways before crossing the street. I also want to give you another piece of information here. Almost all of us cross the street the exact same way. We put one foot in front of the other. At every intersection, whether it is a small street, country road, or whether it's crossing a multi-lane freeway. To walk across the street, it's one foot in front of the other. Okay? Therefore, the reason I made that comment there is that when you take an execution on a trade, you must execute your trades in the same fashion. It is the action part of what you do. Walking across the street is the action part. Standing on a street corner is the information gathering part. Okay? So I'm going to go over some points here as we go through to this. Now, this is not an end-all product. Okay? This is just kind of a reference to help you get started and create some ideas and get the juices flowing in that brain. Okay? You must have a trading plan where you gather information to assess the market conditions. You must have a trade plan when you're going to do your execution, okay? First of all, we're going to take a look at the news. Any news source will do, okay? What I want you to look at is the comments. Is the news positive or negative? How does it make you feel? Good news can be bad and bad news can be good sometimes, so you have to watch how you feel. When we go out to look at, let's find the home page here. When I look at a website like MarketWatch, okay, I like using MarketWatch. It gives me kind of some bullet points. It helps me look at a few things very quickly, okay. When I look at MarketWatch and I want to see really quickly what the market is getting ready to do, how is it setting itself up, I'll look at these things that are highlighted and underlined. Stocks gained for a third time. Now, how does that make you feel? Positive or negative? Euphoria over in Europe may be premature. Uh-oh, how does that make you feel? Treasuries stay down after a 2-year auction. Gold and silver rally, or futures rally. Oil for futures surge. Amazon deals for tablet. HP isn't broken, analysts say. Case-Shiller gauge up for the 4th consecutive month. Don't get carried away by the upturn. So I'm looking at all these headlines. I'm really not going into the details of the commentary, because a large percentage of Americans do not read that stuff. They just go by what the headlines tell them to think. A lot of folks in the stock market right now just go in the market and start looking at charts only, and they have no idea what's going on outside the market that may influence their stock. Keep in mind, when watching your stock go up and down, 39% of your stock's move is directly correlated to what the indexes are doing. Dow, NASDAQ, S&P, and the Russell I use. Global Dow, gold, oil, stuff like that. 39% of your stock's move is directly correlated to what the indexes are doing. 41% of your stock's move is directly correlated to the sector and industry. 41% of your stock's move directly correlated to the sector and industry. Things outside of your chart. If you're just looking at the stock chart and making a trading decision from that, you're not on the correct path, okay? You're close, but you're kind of missing it. You're just walking into the street without looking both ways. 80% of your stock's move has nothing to do with the stock itself. It all has to do whether the tide is rising or falling here, okay? If the markets, indexes, sector, and industry are rising, your stock will most likely rise with it much of the time, okay? So as we look at the headlines, we get a feel for what the market's thinking. Looking at economic reports. Now, this is a really good place to get a good understanding of what economic reports are coming out, okay? But you want to view the economic reports for today and look forward 7 to 10 days. Some upcoming news events can have a multi-day impact on the market. Grade upcoming news items as you anticipate their impact as we approach them. FOMC meetings, usually about 3 days prior to the release of the minutes or release of the decision, the market kind of goes into a holding pattern. The 3rd day prior to, or 3 days prior to, said better, the market has a nice big swing. Then the swings get smaller and smaller and smaller up into the FOMC meeting, much like a triangle, okay? What you need to do, and what I would encourage you to do greatly, is to track the economic reports and their impact in the pre-market. Let's find out what economic reports are impacting the market and which ones are not impacting the market. I remember years ago, anybody that whispered the word oil, the market would move, okay? we don't hear too much about oil. So sometimes these, or nowadays we don't hear too much about oil, but sometimes or many times these economic announcements or reports kind of go in cycles themselves. They're the buzzwords. They're the things that people listen to and talk about. What are we talking about now in the market? Inflation, unemployment, jobs, housing. What are the buzzwords now? There's basically three categories of economic reports. Three categories. One are going to be one category is the basic economic conditions. Are we growing? Or are we contracting? Okay. The other one is usually the reports are based off of interest rates, whether interest rates are going to be increasing or decreasing. And the other ones are inflation-related reports, okay, how we monitor inflation. So you have three categories: inflation, interest rate, and economy type announcements, okay? Now, when you categorize the different economic reports, that's another way to look at the stocks that could be directly impacted by those reports. So if you have a whole bunch of interest rate related economic news, maybe if you're in bank stocks or finance, you might want to pay a little more attention. Trading bonds or treasuries or even futures product, you might get some reaction now. Okay. The next piece of information that I'll look for is the pre-market indicator, the PMI. We can find the PMI indicator, and the place I like to go is www.nasdaq.com. Nasdaq.com is a good place to find this pre-market indicator and also find the after hours indicator. Okay. So here we have the Dow. Let's see, the pre-market indicator this morning was pretty bullish, up 29 points. Okay. Now, if you don't track this information, how are you going to know if 29 is good or 29 is bad? Okay. How are you going to know if 3 is good or 3 is bad? So what I want you to do is track the information and get a feel for when the pre-market indicator is showing we're up 6 on a pre-market indicator. Is that a strong bullish or is it kind of a weak bullish? After today, it's kind of a weak one, but you don't know what 6 does when the market opens. Now, the pre-market indicator is important because it has a 92% correlation as to trader sentiment at the open. It really doesn't help you make a trade, but it tells me what the other traders are thinking. Are they bullish or are they bearish? They feel good about the market, they feel bad about the market. So if the pre-market indicator is showing negative in the pre-market, I want to know how much negative it is feeling. Okay, so by tracking the information, I can find out when is a good day to be trading, or when are my best days to be trading in the morning session, by using that one piece of information to help me see if we're really bullish or we're really bearish, or if we're kind of mediocre bullish or bearish. Okay, what we want to determine is the PMI positive, neutral, or negative. Track the PMI daily to gain confidence in its correlation to market open. You may even take this a step further and say, well, the PMI was up 8 this morning, and after the first hour of the market, the Dow rose 150 points. Okay? Now, one data point is not going to make a good summary. Track this information for about 90 days in a row, and you'll get a good feel for it. You'll train yourself to look for the right pieces of information. The next piece of information that I bring into my toolbox here is the correlation between the indices futures. I'll use the S&P futures, Dow, NASDAQ, and the Russell. Now, think of the indices futures as a family. The S&P being the bellwether. It's also, I consider it a mom and pop. Okay, 500 of our top companies in the United States. The Dow is like the small child as far as a personality. You got mom and dad and it's small child. Now the small child follows the S&P very closely. Well, it should. All the stocks in the Dow 30 are listed in the S&P 500, so the correlation should be there. Okay. The NASDAQ is like the older sibling, kind of running back and forth, always kind of in the lead. Okay, when he's not in the lead, then something's not right. Something's underfoot. Russell is like the disruptive middle child. Okay, he's more active during the spring and summer, and you'll see that the NASDAQ is more active and stronger in the fall and winter. Okay, thus we have, the small cap stocks taking stage usually during the spring and summer. Okay, now NASDAQ and Russell are the two older brothers, and they like to instigate each other. Okay, so they'll kind of fight for the lead time to time. Okay, look closely for the correlation between the futures. Are the overall patterns very similar? Is the movement above and below the 8 moving average, or above and below the 50, or above and below the 200? Are they correlated? If you have two indexes going up and two indexes going down, do not trade in that environment at this moment. Something's not right. The market's starting to turn. Okay, the market's making some decisions. When the indexes are all going in the same direction, that accounts for 39% of your stocks move. So if you're wondering why your stock's not moving one day and the indexes are going the opposite direction, you might have your answer. Another piece of information to bring into your toolbox would be watching the 30-year bonds or the 10-year bonds, whichever you prefer. 10 years have a little more flexibility. The 30-year bonds tend to be a benchmark. Okay, stocks and bonds are negatively correlated. Okay, now we're starting to get into a couple of items that tell me you can trade today at the open or you cannot trade at the open. These are my little, I guess, forward-looking indicators. If I have stocks up and bonds up in the pre-market, something's not right. Stocks and bonds should be negatively correlated. When the bonds are up and the S&P futures are down or vice versa, it's a good indication of a good trading environment. When both the bonds and S&P futures are concurrently up or down, something's wrong. Don't engage the market until one is up and the other's down. Now these are little feeler gauges to say, well, hey, that light on this crosswalk says it's okay to cross. But when I look left and right, I see the mom in the minivan. She's not slowing down. If I put one foot out there, she's going to take me out. Okay? This is part of looking left and right as we get into, we have all of our signals to engage in the market technically, but not fundamentally. Another piece of information I like to follow is the inside day. Okay? What I mean by this, and if we take a little look at a candle pattern or such, let's just jump out to $INDU as an index. Oops. INDU, enter. And let's open up a couple of these charts, or a couple of these bars here. And let's look for where we might have had an inside day. Okay. Here we have a nice example of an inside day. This bar right here represents price trading inside the range. Let me open this up, make it very explicit. This sounds very basic, but sometimes it is very much misunderstood. Here is the prior day's trading range where we're examining this red candle here. Okay? The inside candle, or the candle inside day, this is inside the range of the prior day. When we see price inside the range of the prior day, often the direction, the prior direction changes. So if we're looking at from high to low over the last 2 days, the direction was down. The third day, price was inside the range of the prior day's candle. It was an inside day, okay? I don't need to overbeat that one. But you mark your chart with a horizontal line at the peak and low of the prior day's session. When today's open is within the prior day's trading range, it is an inside day. Inside days are choppy. They are hard to trade. They are designed to take your money. The market's changing directions. Breakout patterns, trending patterns, continuation patterns often fail when we are inside the range of the prior day. Now, if price breaks that range, we broke it. You can start looking for trending patterns, continuation patterns, and breakout patterns after it has been broken. But if we are inside the prior day's trading range throughout the day, you're going to be one of those folks that donate money if you try to intraday trade that time, okay? Often traders will find themselves making excessive trades during that time, okay? Get into some revenge trading and things like that, okay? Just a heads up, if you have 2 trades and you trade intraday, and you have 2 trades that you've been stopped out on, go back and reference the indexes. Find out if you're trading inside the prior day's trading range. Next, we're coming up on this, the Dow 30 stocks versus the Dow futures. Now, this is a gauge that tells me whether we are overbought or oversold. Now, futures follow cash. Sorry to break your bubble, everybody, but if you think futures lead the market, you need to understand some more things about futures. Futures do not lead the market. They may lead market sentiment, or it's traders' sentiment, but they don't lead anything in the market. By their very nature, they are a derivative instrument of the underlying product that they are representing. So if I'm looking at the S&P futures, okay, that futures product only follows what the S&P 500 is doing, okay? That index, that's what it's designed to do. So when I compare the Dow, and see the Dow is the only price-weighted index or a cash-weighted index. This is why this little formula works. It works very well to see if we are in an overbought or oversold situation. Now that can become very handy. If I'm looking to short a trade, I want to be in an overmarket or overbought situation. Then I would have some momentum on my side. Okay. If I'm in an oversold situation, I like to go long. Okay. Now, if I'm oversold and I'm trying to go short, playing a breakout or a continuation pattern, by using this information, I would understand that my risk is much higher, that I will be, or the probability is much higher that my stop will be exercised. How's that? Okay. So when we take a measurement of cash, I use the Dow 30 stocks, not a cumulative, individually. I watch them on my chart while the market is open, and while the market in the pre-market, I always watch it too. Okay. We examine the number of stocks that are greater than or equal to 94 cents, or less than or equal to 94 cents. Now, 94 cents is the cutoff. I use the term, look at it, a dollar up or a dollar down loosely. Okay. But being an instructor and going out there and teaching a lot of folks, everybody wants to know the exact number. It's 94 cents. Okay. If you use $1, instead of using a multiplier by 20 per individual stock that's plus or minus 94 cents, use 18.7. Okay. Now, I don't want to get into that extreme details. If your stock is plus or minus 94 cents, net the result. Let's assume that the futures value of the YM is 70, okay, plus 70. We're up 70 points on the futures. As I look at the cash, I see we have 4 Dow stocks that are plus 94 cents and 2 Dow stocks that are negative 94 cents. So when I net the results, positive 4, negative 2 leaves me with a positive 2, okay? So I take that 2 and I multiply that by 40, or I'm sorry, by 20, okay? I compare the results. I have 40, which represents the cash value, but the futures are plus 70. That would tell me that the futures are overbought by about 30 points. So if the futures are overbought by 30 points, going long and taking breakout trades, I'm going to recognize by taking those breakout trades, the odds are against me, okay? Now, all of this is in written form, and I've made it available with Ron to send out to everybody that requests it or wants it. Take your time and read through this. It's not difficult once you've done it once or twice, okay? It's just a piece of information that kind of tells you if the market is overbought or oversold relative to, or the futures are overbought or oversold relative to cash, okay? In the pre-market, count the number of Dow stocks that are plus 94 cents or minus. Net the result, multiply by 20, okay? Determine the fair value by subtracting the absolute value of cash minus what the futures are doing, okay? Then you'll get to a place where you can see whether we're overbought or oversold, okay? Now, it's just a feeler gauge. Now, if I'm looking for momentum in the market and I'm trading some stocks intraday or trading futures intraday or even options intraday, and I want to create that little buffer as fast as possible, by timing my trade into the market, understanding that 39% of my stocks move directly correlated to what these indexes are doing. This is why we're referring to the indexes. 41% of my stocks move represented by the sector and industry, okay? We want to make sure when we're going long in the market that we have an opportunity where the futures are oversold relative to cash. The public views futures rising as, and they also view that the futures are leading, okay, where actually they follow. People will be behind you in your trade. Momentum will be more behind you in your trade if you set yourself up that way. The other thing for measurement here, this helps us gauge what's going on in a pre-market. Pre-market volume can signal whether the open of today's market will be normal or volatile. Daily measurements of the pre-market volume will show you what is typical or normal overnight volume. Unusually high volume or unusually low volume will give you a clue as if you should be actively seeking to make a trade at the open or if you should be waiting that first half hour. I know in general terms everybody says, hey, don't trade the first half hour of the market. You know, just let the market open. Well, wait a minute. There's some good opportunities sometimes. I don't want to miss those. I just want to understand when I can and when I can't. Okay, so pre-market volume can help me understand if we have a lot of activity going into the open or if we have very little activity. Sometimes we'll see the futures up and stocks up in a pre-market, and CNBC is all dressed in blue and gold and all happy and giddy, right? Then we look over the volume and you got 100 shares move that whole market. 200, 400 shares are what they're building their whole story on for this move to the upside, okay? So what I would suggest to you to get a good feel for this, and this takes several data points, not 2 or 3, but several, like about 90 days worth of collecting this data. Sum the Dow 30 pre-market volume. Track daily via a spreadsheet. Take a snapshot at 8:30, 9 o'clock, and 9:30. 3 times before the market opens. Why do this? Well, at 8:30, I know what the volume is. It's usually pretty light. At 9 o'clock, a half hour later, half hour before the market opens, if the volume has increased by 5-fold, we might see some momentum behind the open, whether to the upside or downside. At 9:30, if that increase continues, we'll know that there's strong momentum at the open, and we need to use that as part of a good piece of information, whether we're long or short. Okay. Note the significant volume change between the current day's pre-market and the next day. Okay. A significant late volume surge leading into the open today can signal an event. Investigate the volume spike. You might find that we have window dressing coming up, and during this week you'll find that, hey, we have some pretty heavy volume 1 or 2 times during this week. Well, it might be a mutual fund liquidating some of its holdings to become in compliance. I mean, that's what they're doing during this window dressing week here. All their high flyers that are now greater than 5% of the total holdings of a mutual fund must be liquidated to become back in compliant. So for this last quarter, last month, if Apple had been surging to the upside, you would find a lot of mutual funds that have Apple as part of their fund having to liquidate a portion of that and put those monies into the other stocks that make up that fund to kind of offset and become back in compliance. Okay, this occurs every month. It also occurs more extreme at the end of every quarter, which is this week. Okay, sorry to get on my soapbox. IBM and Goldman Sachs, another great momentum indicator. Now, IBM and Goldman Sachs are some big monsters in the market. They have a large capitalization in the market. Okay. These two also have a very high correlation as to the S&P and the Dow. Okay. IBM actually has, I think the statistics are, an 88.7% correlation to what the Dow does. So if the Dow's going up and IBM's going down, won't last that way for long. When moving in sync, they signal a direction of the market. When not synchronized, watch until they move in tandem. Often when they're not synchronized, you're going through and all the chat rooms are saying, I'm getting whipsawed. I just got stopped out. I just went long, got stopped out, back and forth, back and forth. If IBM's going up and Goldman Sachs going down or vice versa, it's very choppy trading environment, very difficult for traders to navigate. In the pre-market, though, if IBM and Goldman Sachs are both plus $1 or minus $1, bet on that direction at the open. If they're both positive $1, bet on the market continuing going up. If they're both negative $1 or more, bet on the market going down. Okay. Now, in the pre-market, if Goldman Sachs and IBM are in between the range of plus or minus $1, the morning open is going to be kind of subtle. It's going to be kind of quiet. Okay. But if we see them at extremes, we need to take that into consideration and put these things together. Okay. Now, IBM has about an 88.7% correlation to what the Dow index does. Okay. Watch for them to move in tandem. If they're not moving in tandem, chances are the market's kind of stalling a little bit here. A big one here, the S&P gaps. Okay. S&P gap. The S&P futures, when you're not using the overnight session, they tend to show a gap up or a gap down when the session opens up. The following is given only as a guideline. You must track your own measurements here. It's the only way you'll take, it's the only way you're going to believe it if you're taking your own measurements, okay? Gaps tend to fill as followed on the S&P. If you have a gap up of 1 to 3 points, the S&P tends to fill this gap in about the first 15 to 30 minutes. Well, if you know the gap's going to be filled and you're anticipating getting out of a trade, you might want to wait till that gap is filled, because then price could turn and go back up, and you just got out of your trade the first 30 minutes of the market because you saw a gap. Okay. Gaps of 1 to 3 points tend to fill in the first 15 to 30 minutes. Gaps of 3 to 7 points tend to fill in the first hour, hour and a half. Okay, so if I have a gap up or a gap down, we have pending news at 10 o'clock or at 10:30, I tend to focus more on those times and use the news to anticipate whether the gap is going to fill at that time or not. Gaps of 7 to 12 points tend to fill in the last hour to half hour of the trading session. So here, when we see a gap up or down on the S&P futures in the morning, we tend to get a good feel for when we should see a pullback. How about this morning? How many people were shorting at the open this morning, wanting that gap fill? How many waited for that 5-minute candle, took the short right off that 5-minute candle, put their stop at the prior high, and gave me their money? Huh? This morning's gap on the S&P was almost 22 points. Gaps greater than 13 points do not tend to fill the same trading day. The stops tend to keep, or the short traders tend to keep giving us their money. Now, it's not a great trading day either, because the move is greatly done. But what it does to newer traders is cause a lot of tummy pains, where they're so excited but so ticked off because they refuse to get in because they think the market has gone up too far. Okay? The whole day, if they're day trading, they will spend getting stopped out at the prior high or prior swing high. Okay? But if you know this information, you can put it into your analysis of your pre-market routine. You can say, hey, we gapped up 3 points this morning. This gap should fill on average about 30 minutes into the session. So if I'm looking for a pullback because I expect the gap to fill, does that pullback bring me to a point where I can enter a trade? Is that pullback a place where the market is oversold at that point? Therefore, I can go long and play them with some momentum to the upside. Okay? So the daily measurements of the S&P gaps are very important. Measure your gap openings and number of points. Measure the time required to fill the gap. Track in a spreadsheet. Every student that I've had that has done this and has done this for 30 to 90 days has accelerated their learning curve and become one of the top students that I can brag about in every one of my classes. I guarantee you, just by this one study alone, you will improve how you view the opening of the markets and whether you have momentum or not. Now, why am I talking about futures and gaps and things like that? 39% of your stock's move is directly correlated to these indexes. If you don't know what the futures market is doing and you're trying to enter a trade, you may be entering with a little extra risk. Okay? You may be entering at the wrong time and not anticipating what the behavior might be or understanding that. The final thing that I look at, one of the final things I look at here is the trend. $TRIN is the symbol. It measures the number of the amount of the upticks over downticks, up volume over down volume. Simple ways: when the trend is high, above 2, it's a time to buy. When the trend is low, below 60, it's time to go. Okay? So as I monitor this, I look at the markets here, and on the trend, I have a couple of places that I watch for. It's a couple of patterns and trending patterns, when to look for them. If the trend is below the 60 level, I'm looking for topping patterns. All day today and part of yesterday, we were looking for topping patterns. Okay? As we get into 1 to 1.5, I look for consolidation and trending patterns. If the trend is above 2, I start looking for topping patterns, reversals, okay? I'm sorry, bottoming pattern, reversals. Trend is high, time to buy. Trend is low, time to go, okay? One other one that I'll leave you with, or go into a couple of charts with, but to wrap up the pre-market routine, is the advancing issues over declining issues. Understanding that what these advancing issues over the declining issues, and this is on the NYSE and exchange, okay, is we take the number of advancing stocks over the number of declining stocks, and we kind of place it on a chart here to find out where we're at. If we are positive 1,800 or negative, or positive 1,800 or between 1,800 and 2,000, we start looking for those topping patterns, reversals, okay? We stop going for the breakouts and we stop going for the trends, because historically, when price gets up in that upper range, the market tends to pull back. We have too many stocks that are going up with up volume and upticks here, and it's gotten to an extreme. Conversely, the swings below or negative 1,800 to 2,000, we start looking for bottoming reversal patterns. You'll find most often when you're inside the prior day's trading range, IBM is going up and Goldman Sachs going down, that your advancing issues and declining issues are in this range between positive 500 and negative 500. This is what we deem as a no trade zone here. Just a different way to look at the markets, okay? I put topping patterns, trending patterns, bottoming patterns, no trade patterns. I put these on my chart so I could get a greater understanding of what I'm looking for if the measurement is within one of these ranges, okay? It's just a piece of information. It does not make my trade. It just tells me what patterns to look for, okay? So I have the advancing issues over declining issues you can add to that list just underneath the trend and looking for that, okay? You may consider looking at the dollar index. You also might consider looking at the 30-year bonds index, okay? The pre-market routine, again, is an information gathering process designed to get a good understanding of the trading environment, not to create a bias or make a decision point. As we look at the different stocks on TradeStation, or different patterns that we have, we're using the patterns to find a trade setup, an entry. We're using the pre-market routine as part of that fundamental approach to finding the right fundamentals to match up with the chart pattern we desire to trade.
Jeff, this is Ron. There was a question from RD. I forwarded over to you regarding the PMI and the Dow stock versus Dow futures.
Okay, cool, because I can't see any of the chat going on. So, yeah, anytime feel free to
Okay, I'll read you the question real quick.
interrupt and ask a question.
That's fine. If you want to address it now, great. If not, you could do it at the end. It says, at what point is the market considered overbought or oversold using PMI and or Dow stock versus Dow futures?
Okay, the PMI does not give me an overbought or oversold situation. The PMI just gives me an idea what traders' sentiment is at the open. Okay, just helps me understand, are the novice traders bullish this morning, or are they bearish this morning? What are they thinking? Because look, my 100 shares, my 1 or 2 contracts do not hold up the market. They do not move the market. So I need to know if there are a few more people thinking the same thing at the same price level. Okay, so the PMI does not indicate overbought or oversold to me. It just gives me an idea what traders are thinking at the open. Using the Dow stocks, cash, versus the Dow futures, okay? A futures is a derivative instrument of the cash product, okay? The futures is a right to buy that cash product at a specific price somewhere in the future. It does not have magical powers, okay? It is not a crystal ball. If you're using futures as an indication whether the market's going to be bullish or bearish, you might be a little more safe using the pre-market indicator. It's going to be a little more precise, okay? The futures in the pre-market only indicate traders' sentiment at the open. They do not indicate what is going to happen in the futures. The nature of a futures contract is only to purchase something in the future. It's just like an option, except the contract's words are a little bit different. Okay? With an option, I have the right but not the obligation to perform on that specific option. With a future, I have the right and the obligation to perform. Okay? So there's a little difference in the contract's reading, but they both represent 100 shares of the underlying product. Okay? So again, futures do not lead the market. They may lead traders' sentiment at the open. I may feel pretty good seeing the S&P futures up 25 this morning. Wow, what happened? I'm excited, okay? But I'm also disappointed. Futures being up 25 on the S&P in the morning means we're going to gap and continue to chop all day long to the upside. Not really a good opportunity to take a short throughout the day. Maybe at the end of the day I get a sell-off. Maybe I get enticed to take a short at the end of the day and price runs up and closes above the prior high just like it's been doing. Okay, you have both scenarios. But much of the time you're going to be in kind of a scalping mode when we gap up that much. It's better to see the S&P gap up between about 1 and, let's say, 7 points. That's a nice little rhythm in the morning to be part of, okay? Any other questions I can address, Ron?
That was all right now.
Okay. With that, I'm just going to continue to look at a couple of candidates that I have on my list. Let's look at Hewlett-Packard on a daily chart, HPQ. And I am looking at just stocks right now. And let's go at a daily chart on Hewlett-Packard. And what I'm looking for is, why did price stop down at this low? Is there a reason for it? In order to find a reason for that low point here, I go to the prior swing. And what I'll do is I'll measure the prior swings from above and below that 50 moving average. I'll use my extensions, 113, 127, 1618, and 224. Now look at this. 113, we got a bounce. Well, they tried. 127, they got a bounce. 1618, we got a bounce. 224, we haven't bounced yet, have we? Okay. So what I'm looking for on a daily chart, bouncing off this 224 extension, is I'm looking for somewhat of a V reversal pattern. Okay. If A equals format or edit, excuse me, A equals 224 extension of the prior swing, I set my sights on B to equal a 0.786 retrace of Y to A. Okay. So I measured from X to Y to find the 224 extension. I now measure from Y to A to find that retracement back up. So as I'm looking for the bounce back up in this range, this is the 78.6% retracement of the prior swing. This is what normally happens, okay, on a V shape. Now, when we look at V patterns, okay, any V pattern, we look at that. Here's one. We have a nice little V shape. In the textbook, if you look at Murphy's book, Technical Analysis of the Futures Market, you know, kind of one of those little textbooks of chart patterns and such, okay? What you will recognize very quickly is when they're looking at these chart patterns, especially of a V reversal, is they clearly state that a V reversal pattern is most easily recognized, and get this, once it's complete. Now, what's that going to do for me now? Yeah, that was a great pattern. That really helped me out, okay? But by studying these V reversals, you'll see that we have a Fibonacci extension level that matches up with that range most often, okay? And if I pull from low to high with the last swing above and below the 50 moving average, often I can find it will match up with one of these Fib levels, 224, 2618, or 314. If that happens, then I look for the retracement back up where I can take a profit at a 78.6% retracement of that swing. Smoking, okay? You're going to see, as I start get more familiar with these reversal patterns and patterns that I'm sharing with you, how precisely measured they are. Measurements are important. They add to a trader's confidence once I can measure it, okay? Measuring is information gathering. It does not make the trade, okay? So I see that this was a 224 extension. I'm using the prior low as my stop loss level. Now let's examine the entry. I'm not going to have time to get into great detail on this, but the entry is quite simple. Once price closes above the 8 simple moving average, now I'm using an 8, a 50, and a 200. Once price closes above that entry, I will enter the trade on the very next bar at the open of that bar. I will place my stop at the prior low, below the 8 moving average. That is my risk. What I'm looking for, because this level hit a fib level exactly there and did not close below it, I'm looking at the behavior, which generally happens to move back up into this range. Now, along the way, I have to be careful with different, how about different support and resistance levels, okay? Here's a little resistance level. I have another place for resistance, okay? I also have a place that we may even document as a supply range, because look at the behavior here was different than these. These are just resistance levels because prior levels of a bounce, okay, versus a level where we have kind of a consolidation before we drop, okay. Now, this is a nice little piece of information too. Jot this down and kind of digest it a little bit. 83% of the time, after a continuation play, after a continuation pattern, the next pattern you're looking for is a reversal. 83% of the time, after a continuation pattern, you're looking for the reversal pattern. Now, I'll get into that and explain that much greater in another webinar. Okay, let's get you some trades you can make some money on potentially. Hewlett-Packard daily chart. We're looking for a nice move up back into this range here. Now, is there a lot of talk and chatter about Hewlett-Packard? Of course there is right now. $43. A piece of fundamental information. Let's right-click on this, go to Create, and let's go to Research. Earnings are about ready to come out on Hewlett-Packard. First, are we a value company or a growth company on Hewlett-Packard? One quick reference here is to look at the dividends. If they're paying out a dividend, chances are this is more of a value type company. Okay. Over to the right side here, I see beta. Beta is 110, so it moves a little faster than the index, but it does follow the index. If the indexes are going up, then this product tends to go up. Okay. 39% of your stock's move is correlated to what the indexes are doing. So I want to know the tempo that it's correlated. On this particular Hewlett-Packard company, the beta is at 110, so it's very closely correlated to what the index it's traded in does. Now, the important piece here is the financial strength, especially in these market conditions after a nice little sell-off here. Okay? Book value most recent quarter. Book value for fiscal year. If it is a growth company that does not pay out a dividend, you can value that company for sale at about 2 to 4 times this book value. Okay? Most of those are listed on the NASDAQ. On a New York Stock Exchange stock that is a value company, typically you can value the most recent quarter at about 1.8 to 2 times the book value to be fairly priced, okay? Not over or underpriced, if they're going to sell everything tomorrow, including the last pencil, okay? Book value for most recent quarter is $19.39. Let's make the math easier and multiply that by 2 to get a fair price for Hewlett-Packard, okay? So we recognize that Hewlett-Packard's trading at $23.90. A fair price would roughly be about that $38, $39, $40 level, okay? So relatively speaking, we are undervalued. If earnings come out, you think an analyst is going to say, hey, Hewlett-Packard, based on what they're showing us, is undervalued. You know, we have some really unique things dynamics when looking at a trade entry. We have what you call forward-looking techniques, where you have support and resistance, demand-supply levels, you have trend lines, you have Fibonacci applications you can use, measurements, extensions, and retracement, all forward-looking techniques. Then you have your indicators, okay? Your indicators like that indicate overbought, oversold, momentum, convergence, divergence, things like that. And then you have your fundamental approach. Now, the fundamental guys, they're big, heavy, strong guys. Everybody wants to know what the fundamental guys are thinking. Okay? We want a good company. So if I'm looking to go to this party, here's how I would classify the different techniques. My forward-looking techniques, such as like Fibonacci guys, there were support and resistance guys, the trend line girls, and all that, those are my best friends. Those are my inner circle of friends, okay? Those are the ones I rely on the best. They always show up to the party early. They stay late. They help clean up. They're my best friends, okay? Now, the indicator friends that I have, those are my friends that always show up fashionably late. They always leave early. They come after the buffet's out. They really never help clean up. They never help set up. That, you know, it's kind of fun to have them hang around, okay? But they never really contribute. But friends nonetheless. We all have them. Now, the fundamental friends that we invite to the same party. The fundamental guys, when they show up to the party, they bring the band, they bring the booze, they bring the girls, okay? They make the party happen, okay? So when we look at putting them together, we look at forward-looking techniques, we look at indicators, and we look at the fundamentals. If they all are coming together and we're all looking to have a party at the same price or at the same level, it becomes self-fulfilling. Price changes direction. So at this moment, and sorry to get a little long-winded here, Hewlett-Packard, undervalued, might be where we get a little help from the fundamental guys, okay? We also know that the beta, it moves with the market. So if the markets are going up, Hewlett-Packard will go up. It pays out a dividend. We have earnings coming up here in about the first 2 or 3 weeks of the earnings season, so in the next 2 to 3 weeks here, okay? We have a technical setup using Fibonacci extensions and the retracements. We have forward-looking techniques here. Now, when we bring our indicator guys, and let's throw on what do I have here? How about let's just use MACD as an indicator here, okay? So my MACD guys, have they started to come to the party yet? Or are they showing up fashionably late, okay? Here, it looks like the MACD guys may have even gotten here a little bit earlier, okay, where we have our MACD crossover. Most of the time when we have a turning point above and below the 50 moving average, the MACD is about 5 bars after that turning point, okay? Indicators can only function by data that has been that has already happened, okay? So the MACD guys showed up early for the party, and they're just kind of hanging out waiting for all of us, the forward-looking technique guys and the fundamental guys, to get this party going, okay? Anyways, just an example. Keep an eye on Hewlett-Packard. What I'm looking for on this trade is an entry tomorrow morning, okay, at the open, 23.93, roughly about where it may open, okay? I'm also looking to put a stop loss level at the prior low, 21.51. You may look at options, but make sure you give yourself enough time on options. Well, what do I mean by that? By giving myself enough time, I look for the last 3 swings across a 50 simple moving average, okay? I take the duration of those times, these last 3 swings, and I also take the length of them and maybe even the slope, and I use that to anticipate what this next slope, duration of time, and price movement has a probability of doing, okay? So if you're trading options on this because you don't want to use the stock at the moment, then make sure you have enough time, you know how long the average upswing or downswing lasts, okay? Another chart that I'm looking at for a long trade is a 30-minute chart. On NIHD. 30-minute chart, NIHD, basically about the same scenario. Here's my swing going through the 50 moving average. I'm looking for a trade opportunity. I have my swing going there, and I notice the price came down and hit a 314. Now, 314 is a pretty good extreme, okay? 314 is telling me I should be looking for a V reversal pattern if I'm going to play this to the upside, okay? This is one's a little late, so you're not going to enter this one. You're just going to monitor it. As we look at the low point on this chart, we can see that at the low point, our stop loss level, we had one bar that closed above the 8 moving average. Therefore, the entry would have been on this bar here that my line is touching after price closed above the 8 moving average. So if we opened up in the first half hour, we closed above the 8 moving average. In the second half hour, we is where we would have entered the trade. If A equals a 314 extension, then I'm looking for B to equal a 78.6% retracement back up. Well, look over here. We have a few guys that sold off last time right here, a little level of supply along the way. We also have a gap to fill. A lot of times, and some speed bars or expanded range candles acting as gaps. Okay, so we have some good potential of moving to the upside because of the different things that we have along the way. We have a supply level that's up in the upper range here, so nothing along the way there. Extended range candle or speed bar, if you will, a gap, and we know that price is generally attracted to these levels and wants to fill that whole range. So a little bit further would get us right close. Okay. The important part is to understand why we're looking at this reversal point. Second, our target entry. Why we got into the trade and that low pivot point is exactly where we will place our stop loss order. Okay? We have our target entry as price closes above the 8 moving average. Okay? Now, for those that think the market is going down, then I found more short setups on the smaller time frame, 60 minute and 30 minutes, than I did on the other time frames. I mentioned the ISRG already. Let's take a look at Marvel, MRVL. I'm looking at Marvel on a 30-minute chart as well. I'm sorry to have the lines on there already. Okay. I have a high point and a low point, and then I have price retracing back up. Okay. Price stops at a 113 extension of the prior swing. If the prior swing equals a 113, 127 and on up, I will label that as point A, and the prior swing will be X and Y. Here we go. A equals 113 extension of the prior swing, X and Y. If A equals 113 extension of X and Y, I look for B to equal a 127 or 161.8 extension of the prior swing. The prior swing is labeled at Y to A. Okay, so let's examine where that level is at. From high point to this low point, I'm looking for that extension down to the 127 level. Okay? It can go as far as the 1618, but I can tell you many times I'll step off at this first level. When it gets down to the second level, if it does, I'll look for a reversal play back up. But consider how easy it is to sell or move product when somebody wants to buy it. So if I'm trying to get the extreme highs and extreme lows, my patrons are going away. I don't have as many people that are willing to buy or willing to sell. So as people are looking to buy and sell, I want to give this to them when they feel the best. I can always get my best price at that level. I can always be guaranteed a good exit. Okay? So whenever we put a first target or a second target, don't get greedy here. Take the first target until you understand what you're doing. Okay? Take the first target until you understand what you're doing. Okay, so Marvel 30-minute chart, we are underway. Prior high will be my stop loss. I see that we have down to 1384. We have a little room to the downside. Price closed below the 8 moving average yesterday. Today was the day that we would have entered the trade somewhere on that bar. That was your target entry. The distance between the target entry and the stop loss would be your risk on the trade. The distance between your target entry and first exit point would be your reward on the trade. Okay?
Jeff, if that already hit,
we're looking at this as being a reversal pattern. Go ahead.
No, if that already hit entry, people are looking to get back in. What would be a good price to get back in, or a range of price to get back in?
What we do to find a range of price to get back in is you already see the setup on a 30-minute chart, right? We're underway. If tomorrow we trade up, it might be an opportunity to get in. Okay, but we need some parameters to get in, not just randomness, because what if I get in tomorrow after and it goes back up and stops me out? Well, then I'm not going to listen to Jeff anymore. Okay, so let's zero in and look for a setup at this point and see if we have a setup. The next smaller time frame that I would reference from a 30-minute chart may be a 15-minute chart. My 15-minute chart, I'm still looking for the swings above and below the 50 moving average. Okay, here I have kind of a bounce, no real window above and below the 50 moving average, so I'm going to tune that out and just say that this is one line. Okay, so let's drop down to a 5-minute chart. On a 5-minute chart, I want to verify why price stopped at this upper level, 1565, okay, which is my 30-minute range. Okay, I'm going to take the last swing that goes through the 50 moving average to see if there's a reason why I should have been shorting at that level. So I can take the high point to the low point here. I can see that we went right almost dead nuts on right there, that 1566, right to the tick, we went up to the 127 extension. Okay. Now the 127 extension on a 5-minute chart alerts me to look for another retracement value. Okay. So now I'm going to kind of change this color to kind of blend into the background, okay, a gray color. I want you to focus on this pattern here. And to make this a little easier, let's just take price off the chart for a moment. And let's take the moving averages off, just so we can look at the what we're looking to participate in. Okay, so this is from the other chart. I'll just put it up here. We have a 127 extension. So the prior swing is going to be labeled X and Y. Okay, and this will be labeled A for this time period, 5-minute. Okay, in this case, A equals a 127 extension of the prior swing, X and Y. When A equals a 127 extension of X and Y, I look for B to equal a 0.786 retracement of Y and A. Okay? So let's draw out the right side of the chart. And I'm looking for price to come down to the 78% retracement. I'm looking to measure that swing just so I can get that price level in the right area. Okay. Gets pretty scary when they line up and you don't even have the fibs on them. That means you've been doing it a while. Okay. And some traders, you know, you gotta love them, but you gotta hate them too. Is that they see the stuff without having to measure it. Okay. I'm not one of those people. I have to measure it to get the answer, or it just doesn't feel real to me. Okay. So if you're one of those people that can get those measurements without, just by eyeballing it, well, you know what I think. Okay. Now, if B equals a 78.6% retracement of Y to A, what generally happens is price retraces back to a level about the prior of where that prior X point was, or it uses a C point of the 38, 50, or 618. So C, in this case, can equal 0.382, 0.50, 0.618 retracement of prior swing A and B, or same level, L-E-V-E-L, as point X. Okay? So I have quite a range for this bounce back up. Okay? So what I would anticipate is price to come back up into this range or same level as X, and then I would look for my place to enter from the C point, and then I would estimate where the end of this move is. From my Y to X leg, I would be looking at the 1618 or 224 extension. Okay, so I'm going to put dotted lines on here just to kind of help you visualize the right side of the chart, and what I'm projecting here is I'm looking for price to come down into these ranges here. Okay. So we have C point, and then we're looking for D to equal 161.8 or 224 extension of prior swing Y to X. Okay? So now, as I look at this level down here, let's put a horizontal line on these two levels here. And to answer your question, Ron, as to where do I look to splice back into this? Okay, well, a 30-minute chart, I'm already in. Okay, hit the 113 extension of the last swing up. I'm using a fractal with same rules and guidelines to enter the trade on a 5-minute chart. but I need price to go down lower than come back up before I would get into it. Now my 30-minute chart, since I've already missed my entry, my stop loss is still going to be at this level. On my 5-minute chart, I'm going to splice into this, but I'm going to use this potential level and use the entry over here to splice into it. On the 113, I use this level. On the 127 extension, I use this level. One is a 5-minute, one is off the 30-minute. Let's add price back onto this chart. Okay, we're almost down there. Maybe a nice little gap down would help us get to that level. Okay, now let's go back to a 30-minute chart, for example. Our 30-minute chart, we're looking at our D point to be at 1448 or 1409. Okay, if we have, this is where we're looking to take an exit off our 5-minute. Now, all of these are fractals within a larger swing. Okay, they all have the same rules, the same guidelines as we're going in to take the trade. All swings must qualify by crossing a 50 moving average. We must measure them out. The structures must measure out in order for me to take a trade. I must have proper risk management, a stop loss. I must have a target entry, and I must have an objective in mind before I enter the trade. Okay? A great example of this is if we step back out to the Dow index and we go back to a daily time frame. Okay? On this Dow index daily time frame, we have some very well orchestrated patterns of the Elliott wave. Okay, I mean, textbook. We can tell that the government has been doing their job in protecting the markets extraordinarily well. Okay, we have an inverse head and shoulders pattern. We have wave 1 and 2 and 3 and 4 and 5. Then we have our ABC corrective pattern, and then we have a higher low which starts the cycle move over again. You know, you must have a reversal pattern each time before a trend can start. Now, if Floyd is out there, Floyd's the one that really pounded that into my head. In order to start a trend, you must have a reversal pattern. In order to start a trend, you must have a reversal pattern, okay? So here we have a reversal pattern. This was the low when we went down to 6,500, okay? When I pull the last swing up, I can see that we use a 1618 extension. Wow, okay. That gives me some pretty good information. If this is X and Y point, and this is a 1618, well, heck, can't I just flip this around and see where the end of the story is going to be before I get started? So let's just put the X and Y, and to find the end of the move, I would pull from Y to X and look for a 224 extension, wouldn't I? Unbelievable. This is going to spook many of you, how well orchestrated this market is. Okay? Nothing is random in these markets. It is fractal. Okay? It is very well orchestrated and planned. As we look at Elliott wave, and some folks say Elliott wave doesn't exist, you know, well, I'm okay with the way they think. I'm okay with the way that anybody interprets the market. It is not my job to trade their account. Okay? My job is to trade my account and trade my account the best that I can using all the information on the chart. Elliott wave guys out there, a wave one starts the same way every single time. Price will cross through the 51st, 202nd, and you will have a retrace. Price crossing 51st, 202nd, and a retrace. Prior to a wave one, you will have a reversal pattern because you can't have the first impulse wave without some stability to support it. As we look at this last move to the upside, okay, we have price swinging up, pulling back prior to wave one. Wave 1 costs 51st, 202nd. Now, I am pointing a lot of subtleties out, and I'm pushing a lot of information in this little presentation. Much of it I can explain later if I'm invited back, if you like this stuff. Now, Ron asked you before the show started to please let him know. If you think Jeff who you are or whatever, then tell him that too, okay? And he'll find somebody else to do it. But if you like what you're seeing, want more of it, let me know. Let Ron know. He's the one that's the master behind this, okay? So I have wave 1, 2, 3, 4, and 5. Elliott says there are 3 rules. Wave 2 must not violate the lower wave 1. Check. Wave 4 must not enter price territory of wave 1. Check. And wave 3 must not be the shortest. Check. Okay? And here's the 4th rule. Before the beginning of wave 1, there must be a reversal pattern that measures out. Okay? Now, in order to change a direction in trend, we must have a reversal pattern. Bing. And we have a retracement back up. Now, notice this low is lower than the prior low, or this high is lower than prior high. If we have a reversal pattern, this should measure out. 88.6. That's one of those reversal patterns. If A equals 88.6, then I have my setup X, Y, and A point. The end of the move should result in a 1618 or 224 extension of Y to X. Whoa, hey, that's pretty cool. Went right down there twice. Bing, bang. Okay? The beginning of every impulse wave, or beginning of a cycle move, starts with price going through the 51st, 202nd. We then might see a price bounce back up, wave 1 and wave 2. Okay? If we have a swing going through the 51st, 202nd, and we're projecting from that pattern alone, that swing alone, where price may end up, most common is a 1618 if price crosses 51st, 202nd. If it only crosses the 50 moving average, and most of the time we look for an extension of 127. Okay, so let's just take a quick little look at this. This last swing up crossed only the 50 moving average. So if I'm going to use high point to low point to estimate where price may change here, I will look for the 127 extension. Oh, okay. So that one played out. If price crosses the 51st, 202nd, then I look for wave 3 to be at about a 1618 extension of that swing. Could be just a coincidence, you know. But darn it, these things happen way too often to ignore. It's a matter of how you are going to assess your information, create the mean for your measurements here, okay? Now, I've gone way over what Ron told me I could do, so I'm going to hand the mic back over to Ron, let him wrap up the session. Please give Ron your opinion. Let him know what you think. Let him know if you want more, or if you want to do some live sessions or something like that, okay? So, Ron, here you go, and thank you very much for the time to spend with all your folks. I hope you guys got a lot out of it, and there you go.
Great. Thanks, Jeff. I appreciate it. What I'd like to do is, if anybody has any questions, feel free to ask them in the chat box. We will be doing a follow-up with an email later tonight. And if you have any suggestions for future webinars, please pass that along too. We would like to set up a series with Jeff, perhaps a bunch of lessons, maybe once a week for the next 3 or 6 weeks. If you are interested in that, let us know, and we'll follow up with you and try and set that up. I don't see any questions right now. What I'll do, like I said, is I'll follow up with an email, and we'll go from there. So I appreciate everybody attending. Jeff, thank you again. I'll follow up with you tomorrow. Okay, everybody, have a good evening.